Everyone's chasing AI, crypto, and the latest SaaS unicorn. Meanwhile, Ferrovial is over here quietly racking up inflation-linked tolls and building airport terminals that print cash for decades. Sound boring? Good. Because boring is sometimes brilliant. Look, I'm not here to pitch asphalt like it's the next Nvidia. But in a world where most investors are addicted to dopamine, Ferrovial operates like an engineer with a 50-year blueprint. No hype, no headlines, just high-margin toll roads, locked-in contracts, and long-duration compounding. So the question is, can this capital-heavy infrastructure player actually outperform the market over time? Or is it just another low-return value trap dressed up as a pension fund darling? Let's get this out of the way. Ferrovial doesn't make software. It pours concrete. It builds managed lanes in the US, airport terminals in New York, and transmission lines in Chile. Through its Sintra brand, it owns toll roads where drivers pay a premium to skip traffic. These aren't just any roads. Think LBJ Express in Dallas or I-66 in Virginia. Congestion is your friend here, because the worse it gets, the more Ferrovial earns. Dynamic pricing makes these toll roads resilient cash machines. Traffic rises, so does revenue. Inflation ticks up, prices adjust. You're looking at 70–80% EBITDA margins on assets with 30 to 50-year concession terms. Try finding that in software. Then there's JFK's New Terminal 1. Ferrovial isn't just building it, they're running it. That means parking, commercial leases, landing fees, recurring inflation-linked revenue from one of the busiest airport terminals in the US. Not bad. Energy? That's the wild card. Ferrovial is stepping into solar generation and grid infrastructure. It's early days, but the TAM is huge. This isn't some greenwashing side hustle. It's a real bet on the future of electrification. Transmission lines, if built right, are modern-day monopolies. Financially, it's tight. The parent company holds net cash. Over 20% insider ownership from the Del Pino family means capital isn't being thrown around for vanity projects. They exited their low-return services business. They sold Heathrow. Why? Because they found better places to deploy capital, like JFK, managed lanes, and energy. Now let's talk return on capital. Here's where I raise my eyebrow. Consolidated ROIC is under 5%. That's below the cost of capital in most scenarios. But, and it's a big but, ROIC at the asset level looks much better. Core toll roads likely generate 20% plus ROIC once fully ramped. Still, until that's clearly visible on the consolidated P&L, we're pricing in a lot of hope. Revenue growth? Toll road revenue has tripled in just 4 years, from $439 million in 2020 to $126 billion in 2024. That's impressive. Energy revenue is growing triple digits. Construction is still lumpy, but it funds the vertical integration. Earnings per share? Messy. One-off gains, like selling Heathrow, skew the data. Adjusted EPS is growing, but let's not pretend this is a compounding rocket ship yet. Free cash flow? Here's the rub. 2024 FCF was negative $404 million. Why? Because they're investing heavily. JFK, IRB, new transmission lines. Now that's fine if the returns justify it. But if you're an investor who cares about smooth year-over-year cash flows, this isn't your stock. Valuation? Rich. On normalized FCF, Ferrovial trades at 43.65x EV/FCF. You're paying up for stability, inflation protection, and long-term contracts. And that's fine, if the cash ever shows up. Ferrovial isn't cheap, and it isn't flashy, but it's probably one of the most underrated compounding platforms in global infrastructure. You've got regulatory moats, IRR-focused capital allocation, and real assets with inflation-linked revenue. The risk? Execution, ramp delays, inflation in CapEx. But if they deliver, and that's still an if, you've got a 20-year cash flow engine here. Curious but skeptical? The full breakdown, warts and all, is at norabob.substack.com. Link below.